there goes the bell, and the first rate on the Nifty is very close to 18,750. It's facing resistance around that 18,750 mark.
Mid-cap index is up around 0.3%.
100 points now, right? So things are looking pretty good, 90 points to be precise. But slowly but surely, the markets moved up to the high point of the day.
Given the HDFC boost that we had, the HDFC Limited stock, the HDFC Bank stock as well, they put on good gains, and that's what fired up both the Nifty Bank as well as the Nifty Financial Services.
It was an extremely interesting day of trade today. We started out flat, insipid, with the mid-cap index outperforming way more than the frontline indices. Towards the end, we had the Nifty Bank outperform, and that was largely on account of HDFC Bank. In fact, the Nifty too ended up piling on over 125 points, closing above that 18,800 mark. This as the HDFC triplets, HDFC Bank, HDFC Limited and HDFC Life, boosted the market in second half of trade, also led higher by the Nifty Financial Services expiry. Was an interesting day of trade, which started with the mid-cap outperformance and eventually ended with mid-caps underperforming because the large caps did extremely well. You're watching us here on Markets Today, a show where we track 6 hours of day's trading action in 5 headlines. Market closes at the day's high with the Sensex and the Nifty gaining over 0.5% each. A surge in HDFC Group stocks sends the Nifty Bank over 1% higher. Stock exchanges also rescheduled the Eid al-Zuha holiday to Thursday, the 29th of June versus Wednesday, and as a result of which the Nifty June CD's expiry will now be tomorrow. That's on Wednesday. The biggest transaction of India's corporate history will become a reality now in 3 days. The merger of HDFC Limited and HDFC Bank will become effective from the 1st of July. HDFC Chairman Deepak Parekh says the board meeting on 30th June approved the merger will be its last. REC tells CNBC-TV18 the lender's assets under management can expand to 10 lakh crore rupees by 2030 on the back of growth in renewables and infra financing, while Bharat Dynamics expects to double its sales by FY27. A study about Tata Motors, it gained as its subsidiary Tata Tech got an approval from the Market Regulatory Board for its IPO. Cyient DLM's IPO gets oversubscribed on day one. AB Capital 2 gains on floating a QIP. PB Fintech and wood panel names rally as brokerages bet big on these stocks. Electronics Manufacturing Services also sees a gain as Avendis initiates coverage on them. Let's tell you what we have lined up for you on the show today. It's a packed show. In Market Opinion, we have Andrew Holland, Chief Executive Officer at Avendis Alternative Strategies. Big corporate voices, we have HDFC's Chairman Deepak Parekh, CEO K.K. Mistry as well. Let's talk about the first headline itself. A quick wrap of reaction on the Lal Street. Nifty, Sensex and the mid-cap index ended close to 0.5% higher after trading in the green for a better part of the day. Nifty Bank was the one which outperformed in the second half, led higher by HDFC Bank, and the Nifty Financial Services led higher by HDFC and HDFC Bank. Gains largely driven by a sharp uptick in the shares of both these HDFC twins. Prashant Nair joins in with the details of that. Prashant.
Well, we started on a dull note. The market picked up, made the day's high early on. Then it was dull. For bulk of the session, it was dull. And then things picked up once again towards close, starting about 2 p.m. or so. We went back to the day's highest point and then kept going. We are back above 18,800 as far as the closing level is concerned, and new highs are in sight once again. Global cues supporting. I'll get to all of that in just a bit, but banks also coming up on your screen. Well, actually, the Bank Nifty did better than what the Nifty did. Well, there was reason, right? HDFC, the entire group was in action. HDFC, HDFC Bank, HDFC Life, all are parts of the Nifty. These stocks fired. Actually, the HDFC and HDFC Bank twins, they did very well, contributing bulk of the gains that we had in the Nifty Bank as well. But other financial names like SBI and SBI Life also did well. Apollo Hospitals and JSW Steel were some of the others which participated on the way up. In the broader market, advance decline was pretty strong in favor of advances. AB Capital, there was a QIP which is on. Stock did very well. Metropolis did well. I mean, some of these diagnostic companies last couple of days are coming back into the action. RBL Bank, Green Panel, Canfin Homes, Force Motors, Surya Roshni, Sequent Scientific, Action Construction, Sirma, LG Balakrishnan. We had Landmark, which is the premium car dealership, which was down 5, was up 5 in trade today. Some cuts as well, but minor, not a long list. You had MapMyIndia, Barbecue, and 5-Star, which were under some pressure on volumes. Well, as I said, if global cues remain supportive, if some of the recent correction that we've seen on the Nasdaq, S&P, etc., starts to reverse, and global risk-on sentiment is more supportive, I think new highs are coming here for the market. We're very close to it. So once again, the countdown to new highs, which was missed by 1 point last week, restarts with the gain that the market clocked today. Back to you.
All right. In fact, I was going to end this show by saying see you day after tomorrow, because tomorrow was supposed to be a holiday. But now that market holiday has been revised, this is the market holiday for Bakri that we're talking about, has been revised by the stock exchanges, the NSE and the BSE. Markets will now be closed on Thursday instead of the earlier scheduled holiday on Wednesday. The RBI too has changed its holiday for the banks and financial institutions to Thursday from Wednesday. Let's talk about the market itself then. In Market Opinion, we had Andrew Holland, the Chief Executive Officer at Avendus Capital Public Markets, alternate strategies, and he said that the markets are currently complacent at the moment. He says that, there are a bunch of sectoral bets that he's made, and he's laid them out for us.
I think we're all complacent, to be honest. I think, I've been more constructive on the market, so please, I'm not trying to be overly negative here at the moment. If markets do fall, then I'd be buyer on those dips. But I just feel that markets look globally a bit tired with no real catalyst, and the only real catalyst is either higher rates and slowing growth, as we're seeing in Europe. We've expected this market to be kind of volatile, because of all the different events that we've been seeing, but it hasn't really been, the volatility's not been there. The problem I find on the defense sector, and it's something which doesn't help in terms of valuing companies, is that the orders are very lumpy and you'll never know when they're going to come in. But obviously, my view, this is over the next 2 to 3 years is going to be two sectors which will continue to race ahead, and therefore you need to be involved in some of those stocks, although it's limited on the defense side. 4 or 5 months ago was obviously the kind of more kind of new age companies, the kind of Paytms of this world, Nikes, but we did some homework on that, and some of them have actually kind of moved ahead quite well.
All right, let's also get you the second headline now and the top story of today. HDFC and HDFC Bank rallied nearly 1% each. The merger between the two entities will be effective from the 1st of July. Shares of HDFC are expected to stop trading on the 13th of July, and the shares of the merged entity should begin trading from the 17th of July itself. HDFC Chairman Deepak Parekh said that both boards will meet on the 30th of December to clear and approve the merger. This will be HDFC's last board meeting. Parekh also said that employees of both entities will not be affected adversely by the merger.
Assurances we've got from the bank and from the CEO downwards, each and every employee under the age of 60 will be absorbed. Salaries will not be reduced, and they would continue to do mortgage loans because we need them.
So the bank does everything other than housing, and HDFC only does housing. And therefore the commonality of roles is very limited. It's limited to certain corporate functions. So that makes the process of integration a lot simpler than what you would see in a merger of even two small entities. Forget about two large entities. Because there you have commonality of products. If you have two banks merging, both banks have car loans, both banks have consumer loans, both banks have housing loans, both banks have, different, which is not the case here. So the integration will be easy.
All right. It would be an interesting and the biggest merger in the history of India once that happens, and not too far away, just 3 days from now. The third headline today, RDC raised nearly 3% on bullish management commentary coming in. Chairman and Managing Director of the company, Vivek Kumar Devangan, said that the lender's assets under management can expand all the way up to 10 lakh crores from under 4.5 lakh crores right now by 2030 on the back of growth in their renewables and infra financing. In fact, he also expects their borrowing cost to go down and net interest margin to improve. All of this while the asset quality of the company improves further. So all-round bullish commentary coming in.
Last year, our net interest margin was about 3.38%, which is quite good as per industry standard. But however, 1/3 of our borrowings are at market floating interest rate. And as you are aware, the last year, this interest had gone up. That's why our net interest margin were affected. But going forward, now we expect that borrowing cost will go down and our net interest margin will improve. With regard to our asset under management, our total outstanding loan as on 31st March 2023 was about 4,35,000 crore, which was a significant improvement of 13% on year-on-year basis over the last year. And going forward, we are targeting to take up infrastructure projects as well as energy transition initiatives. And the next 7 years, by the year 2030, we are targeting that our loan book will increase to about 10 lakh crore. In FY24, we are targeting that it will at least touch 4,80,000 crore.
All right, with that, we'll take a short break. Come back. We'll be back in a jiffy with all the other headlines. Welcome back. You're watching us here on Markets Today on CNBC-TV18. We've spoken about the late recovery in the market, the HDFC twins, and a bunch of other stocks making news today as well. But let's talk about the fundraising plans of a bunch of companies. Cyient DLM's IPO, Cyient's arm that is, got subscribed by 2 times on day 1 itself. Retail investors topped the bidding list, subscribing the issue so far by almost 9 times. The company aims to raise almost 600 crore rupees through this fresh issue. Reema Tendulkar joins in with more details on this one. Reema.
Thanks so much for that. So Cyient DLM is an integrated electronics manufacturing services company, an EMS company which largely caters to the aerospace, defense, medical tech and industrial. So aerospace and defense nearly contributes about 60% to its overall revenues. Now the company is looking to raise 592 crore via the IPO right now, which is open today. They did a pre-IPO placement of 108 crores and plus they raised about 260 crore from anchor investors. Now the money that they're raising is a fresh issue. There is no offer for sale. Now, EMS in India is very hot because there are a lot of tailwinds. Investors are very bullish about the growth prospects of EMS. Now, the size of the EMS industry in India was about $20 billion last year, and this is anticipated to grow or increase 4x to $80 billion by 2026. And particularly because Cyient DLM caters to the aerospace defense vertical, there are high entry barriers, very stringent quality and qualification requirements. A quick word on the financials. The revenues of the company were about 832 crore. The margins were hovering around 11 to 12%, but when we chatted with the management, they did say margins will improve to 12% in the next 1.5 years, and then further rise to 13 to 15% in the next 3 years.
The business split right now is primarily built to print, which is essentially somebody else has done the design and we're the contract manufacturers. That is the overwhelming majority, 99% or so is that. We continue to see that happening for the next year or two. But having said that, the whole intent is going forward based on how the pipeline is looking and based on how the order book is shaping. We see that we will have a lot more design control or we will do a lot more build to spec work in the next couple of years. So the margins on the build to spec are significantly higher. For the simple reason that when we design something, we have a lot more control on what parts do we use. Therefore, we can optimize based on the cost of parts, availability of manufacturing processes, and so on and so forth. The design to specification part will change in the next 3 to 5 year time frame. If you look at the the way that we're building our margin bridge is we are at about 11%. Natural number should be 12%. We've made a lot of investments in the last year, especially with leadership, with supply chain, with technology, etc. So we should come back to that 12% within the next 12-18 months. Then we have a runway based on further supply chain optimization, utilization, given that we're running at about 1/3 capacity, etc., etc. There's a number of levers that are there that will help us to get to 13 to 15% margins in the next 24 months.
All right, so that's about Cyient DLM, but Aditya Birla Capital, that is, also was a big gainer in today's trading session. It was about 6% after the company launched a QIP to raise funds. Sources tell CNBC-TV18 that the company plans to raise up to 1750 crores via the issue. Abhishek joins in with the details of that one. Abhishek, the stock ended at the high point of trade. It's a big mover today.
As you mentioned, the company has floated a QIP of about rupees 1,750 crores. The floor price is at rupees 176 rupees per share, which is at a discount to about 3% to yesterday's closing price. However, right now the stock is at 52-week high. So the proceeds of the QIP will be used for meeting capitalization of the company and its various arms, that is insurance or mutual fund, etc. Management change has been seen in Aditya Birla Capital. So Vishaka became the CEO since 1st of June 2022. Over the last 1 year, the stock has performed really well by about 104%. Financial performance post the management change, if you see on a PBT basis, that is profit before tax basis, NBFC business has done well in FY23. Housing finance business has done well, and even general broking business has done well. The losses have reduced in the health insurance business, and mutual fund business, that's the only weak point that they have seen in FY23 versus 22. So in terms of return on equity, it's expanded by almost 120 basis points over the last 1 year. FY23, the return on equity is around 11.5% when compared to 10.3% on a year-on-year basis. So the process of improvement started in FY21 itself, and the NBFC and housing finance business growth that you're seeing right now is similar to the growth that you saw in FY21 as well. Back to you.
All right, Abhishek, thanks a lot for that. So that's about the HDFC, that's about the Aditya Birla Capital fundraising plan, beg your pardon. But let's talk about some stock-specific news as well. Tata Motors is the other one, which gained after its subsidiary, Tata Technologies, has received the approval from market regulator SEBI to raise funds through an initial public offering. So this is purely an offer for sale where the company will set up to nearly 24% stake of its paid-up share capital, and as a result of which Tata Motors, which stands to get the money, was the share that rose in today's trading session. So that's about all the fundraising story that we got today, right from Cyient DLM to AB Capital to Tata Technologies. Let's talk about some brokerage calls now. That's the fifth headline of the day. PB Fintech and wood panel industry names like Green Panel, Green Lamb, Greenply were all gaining in today's trading session on the back of brokerage views. Let's start with PB Fintech. So PB Fintech basically, has been gaining over the last couple of trading sessions, and that's largely on account of the analyst meet that we saw from the company a couple of days ago. And yesterday, there were a bunch of brokerage notes that came by as well. Today's up move, however, can be attributed to CLSA, which has an outperformed rating on the stock with a target price of 720. Mind you, the stock at one point was above that 720 mark as well, though ended mildly lower from the highs of today's trading session, still ended with a gain of about 2.5%. What does CLSA say? Well, the company's plans with regards to its core business are extremely strong. Core insurance business, protection picking up, high base for the savings business. However, what they like the most is the way the profitability of the company is likely to look. In FY24 itself, they expect the company's profitability to break even though there could be no big change in the near term, and FY27 net profit seen at around 1,000 odd crores. So those factors led the stock to move higher after a big move that we saw in the last couple of trading sessions as well. But the other group that was doing well today was the wood panel industry, and that's basically, all the Green Lamb, Green Panel, Century Plyboards and Greenply kind of companies which make plywood, they make particle boards, and they make medium density fiber board, which is MDF. Green Panel, DAM Capital initiated coverage on Green Panel and Green Lamb. Both of them initiated with buy, a target price of 470 and 540 on Green Lamb. These stocks were the bigger gainers, whereas on Century Ply and Greenply, they already had coverage, so they maintained their buy ratings with 750 rupees as target price for Century Ply and 210 for Greenply itself. In the near term, there are some headwinds, and the biggest headwind is one, timber shortage, which has driven the key wood prices higher. Secondly, there have been lukewarm demand post the price hikes that these companies have taken, which means that raw material inflation pass-through gets a little more difficult. And at the same time, we've seen a lot of import coming in from medium density fiber boards and particle boards as well. And domestic MDF capacity is expected to rise by over 50% over the next 3 years. So that would cap the prices that would see in medium density fiber board as well. However, having said that, there is a lot of potential also for large players. Leaders' market shares generally don't exceed 20% in this industry, which leaves a lot more headroom. Fairly strong balance sheet from pre-COVID levels. We've seen a lot of the companies actually deleverage their balance sheet, and even if they're taking debt, the debt for capex will be in controllable levels, and highly unorganized industry share is still up for grabs. So as a result of which we counter-check those facts with Century Plyboards as well, and they said that demand is slightly muted indeed, but they are gaining market share in plywoods business steadily. Plywood market share for them is 7%, again corroborating DAM's view of no large player having more than 20% market share. And there is a strong case for anti-dumping duty on MDF, and why even as India's MDF capacity is increasing by 50%, will still be a lot less than the demand that there is. So that's a big positive. So that's about the wood panel industry, but let's get you some more brokerage outlook as well. Electronics manufacturing services companies, they were buzzing in trade today after Avendus Spark initiated coverage on that. Brokerage firm said that production-linked incentive schemes have accelerated the process of local manufacturing, and as a result of which we saw big moves in the names like Sirma SGS and Avalon as well. For more details, let's go across to Vivek Iyer.
Well, that's right. The entire space has been abuzz recently, the electronic manufacturing space. So today, Avendus Spark has come out with a report. They've initiated coverage on 3 of the companies. So Keynes Technology, Syrma SGS, as well as Avalon. They have, add or a buy rating on all of these names, and they're extremely positive on the space. So they have 4 key reasons why they continue to remain positive on the EMS space. Number 1, they believe the growing trend for import substitution. And what they're saying is that, there is significant scope for this particular theme to play out, given the fact that almost 80% of the printed circuit boards as well as box build products are at this point of time actually imported from China. Apart from that, what they're saying is that the production linked incentive scheme is something that has accelerated the process of local manufacturing. Along with that, the China Plus One theme, where a lot of global firms, especially US as well as European firms, are shifting their sourcing from China, to other sources, and key amongst them being India. Lastly, what they're saying is that the rising share of electronic content across major end user sectors like automobiles, consumer durables, and industrials provide a significant scope for these companies to go ahead and actually increase their revenue pie. So what they're saying, they're expecting Syrma as well as Keynes to go ahead and grow at almost 28-25% CAGR, over the next 4 years from FY23 to FY27, and they continue to like these names. Despite the fact that valuations at this point of time are quite expensive, they continue to like the names, and you're seeing these stocks outperform, and even today a few of these names are doing quite well in the session.
All right, Vivek, thanks a lot for that. With that, we are out of time on this edition of Markets Today. Thank you so much for watching. Stay tuned to CNBC TV18 for more news and updates.